It was a pretty crappy wake-up call to learn that, having great income and paying your bills on time aren't enough to guarantee a great credit score.
Who the f*** am I to tell you what to do with your money?
My name is Priya Malani, ex-Merrill Lynch, ex-Wall Street, extremely type A, the kind of crazy you want in charge of your cash. Currently managing millions of hardworking dollars for hardworking, high-earning 30-somethings like yourself. Whatever phase you're in, financially free, fixing it,
Or feeling totally
my job is to teach you the stuff that no one else is going to. Enough foreplay. Take off the jeans, put on the sweats, grab a glass, and let's talk
money.
Welcome to the F word. Smart money.
No bull.
Hey guys, today we're talking about credit scores. Credit scores and credit cards, while closely related, are obviously not the same thing. And I really just wanted to break it down, like how the credit score works, so you guys can start leveraging it to your advantage. Super powerful, so let's get into it. Today I'm going to tell you the easiest way to keep your score healthy and also the fastest way to increase it. Just for anyone at the beginning of their credit journey, you may want to look into a secured credit card or becoming an authorized user as a quick way to start building your credit. Just a quick note. But for the purpose of this episode, I am going to focus on high earners who want to optimize their credit score. So credit scores, luckily, are fairly straightforward. They basically show lenders how likely you are to repay a loan. The higher your score, the more confident the lender is in you. If you have a crappy score, a lender is going to assume that if they lend you money, you might miss a payment or maybe you won't pay them back at all. And honestly, it just makes it harder and more expensive for you to borrow. So focusing on building your credit score is a really important thing to do, especially because it becomes crucial when you need to finance a big purchase, thinking like a home or a car loan. The better your score, the lower your interest rate will be, and therefore the less you'll pay over the life of the loan. And when it comes to a mortgage or a car loan, a lower rate could mean tens or even hundreds of thousands of dollars in savings over the life of your loan. So it's a big deal. Now, when you apply for new credit, the lender does check your credit report. Okay, that's called a hard inquiry. And it's really nothing to freak out about. Yes, it can cause a small temporary dip in your score. So one way to mitigate this is if you're shopping around for a mortgage or car loan, you can avoid multiple hard inquiries by getting yourself organized, basically, so that you can shop around within a tighter window of time, like ideally 30 days. That way, all of those hard inquiries count as just one inquiry and won't hurt your score as much. Now, to be clear, your score is just the beginning. A good credit score is going to open the door to better interest rates. But if you don't manage your credit well, you might still end up paying more over time, even with a good credit score. Now, one of the easiest ways to keep your credit score healthy is by making your payments on time. Quite frankly, not going to sugarcoat it. There's really no reason not to do this. Find a system and implement it. Maybe you create a recurring calendar invite, or even better, just set up autopay. I'm just going to take a quick side note here because this is something that just really bothers me. If any of you have ever heard that keeping a balance on your credit card helps your credit score, never take advice from whoever said this again. It's not true. Carrying a balance from month to month and not paying it off in full not only doesn't help, but it actually can negatively impact your credit score. So the bottom line here is pay your bills on time and in full. All right, enough of that. Now, I want to talk about the second largest component of your credit score, which is called your credit utilization ratio, or CUR, because this is one of the easiest to affect and to fix quickly. So I'm going to tell you about Ryan, a marketing exec. He was making $350,000 and he was getting ready to buy his first home. However, he was blown away that he had accidentally or unintentionally totally messed up his credit score. And this comes on the heels of the fact that he always paid his bills on time and had a decent credit score from what he could last remember. He was somewhere in the 700s. So when he went to get approved, he figured no issue. But the mortgage lender came back and hit him with a pretty big surprise. His credit score had dropped significantly into the 600s. So after some digging, we realized that what happened was his credit utilization ratio had skyrocketed just in the last year. He had been traveling more and received a recent sizable raise, which obviously resulted in him upgrading his lifestyle. So that part's fine, but without realizing it, what he had been doing was maxing out his credit cards every month. Even though he was paying his credit card balances off just in time for the due date, he was never letting the balances drop low enough before the statement closed. So this goes back to a hack we talked about in episode 3. If you pay off your balance right after the billing cycle closes, you can avoid this unnecessary mess. So, obviously, a couple quick fixes. We were able to get him back on track, but it was a pretty crappy wake up call to learn that, having great income and paying your bills on time aren't enough to guarantee a great credit score. So, as I've mentioned, the good news is that your CUR is an easy thing to fix. Again, just to kind of simplify and recap, your CUR measures how much of your credit you're using relative to how much you have available to you. We'll take a quick example. Let's say you have 2 credit cards, each with a $50,000 limit. $50,000 times 2 credit cards means your available credit is $100,000. In a month, let's say you charge up $10,000 across both your cards. That means you're using 10% of your available credit, that $100,000 number. So your CUR is 10%. Now, once you pay off your balance in full, your CUR, your credit usage, drops to 0, obviously, as long as you don't have any other debts. I certainly see people, I've even done it myself, open an extra credit card or two to help lower their CUR, because in essence, what happens is by opening an extra credit card, it increases your available credit. Frankly, I'm fine with this. It's fine as long as the cards that you open don't come with like a hefty annual fee or have a rewards program that you're just not really benefiting from. I once talked to someone who thought that the more you spend and pay off on your credit cards, the better. Now, to her credit, it kind of makes sense, right? If you rack up a lot and then you pay it off, you must have great cash flow. But unfortunately, credit scores don't think of it this way. They respond much better if you keep your credit utilization ratio under 30%. Anything above that, and it kind of starts to look like you're living a little too close to the edge, financially speaking. Even if you're paying on time, actually, going over 30% can raise a red flag for your credit score. One other thing to keep in mind is that your credit mix also matters. Lenders usually like to see that you're responsible across different types of borrowing. So, credit cards, a mortgage, auto loan. It shows you're capable of handling a variety of credit products. But, and this is a big but, don't go out taking out new loans, new credit cards, just for the sake of it, obviously. Keep your balances low and make sure you're managing everything responsibly. Now, while your CUR under 30% at any given time is the ideal, if you're trying to hack your way to a better credit score, even lower is going to be better. So, let's talk about the hack to the hack. If you want to bump your credit score quickly, this is my favorite hack. Keep your CUR as low as humanly possible by paying off your credit card even more frequently. So you can pay it off every week, every 2 weeks, and do this instead of paying it off at the end of the billing cycle, which is the typical thing we suggest. Essentially, what this does is it means you're giving yourself less time, just that week period or 2-week period, to rack up a balance that could negatively impact your CUR and therefore your credit score. Now, the opposite approach, which I briefly touched on earlier when I mentioned opening up a credit card, this also works, right? So here, instead of using less of your available credit, you can just make more credit available to you. About once a year, you can call your credit card company, tell them you got a pay bump or that you're in a different situation financially, and they'll usually respond by increasing the limit on your credit card. So similar to what we were talking about in episode 3, in order to reset your billing cycle, this does involve a phone call. Sorry. Sometimes you can do it via the chatbot online, but you have to pick up the phone. Also, this strategy only works if you don't increase your spending along with your credit limit. So just because your credit card company gives you a higher limit, you can't start increasing your spending. You need to keep your limit high and your monthly balance low, or you'll negate the benefit. So I want to be clear that while these tricks to lower your CUR and boost your score quickly definitely work, I want to impress that it's the long-term habits that actually are what you should be focused on. So paying your bills on time, avoiding maxing out your credit card, and in general, just keeping your credit history clean so that it doesn't have a bunch of old stuff on it. That's what builds lasting credit health. Quick fixes are great, but it's not a replacement for steady, responsible credit use. So I'm going to end on something that, frankly, I don't do very well. They say it's a good idea to check your credit report once a year to make sure that everything's in order. You can do it for free on annualcreditreport.com. Just, avoid any of those sketchy sites, although last I checked, the site could use a bit of a facelift. But going through your credit report can help you catch any errors or fraud that might be impacting your credit score without you even realizing it. It's also a good way, as I was talking about earlier, to spot any old accounts or debts that are just sort of lingering, hanging out. They shouldn't be there anymore, so you can clear those out. Again, I haven't done this in years, but the best practice is to do it once a year. Currently, my credit score is sitting at 800. I just checked. And the way I do it is I monitor it via the CreditWise app, which is available through Capital One Bank. You don't have to be a client of theirs to use the app. And I'm not affiliated with Capital One. But I've been using it for a very long time, and it has some pretty cool alerts and notifications built in that I kind of use as a prompt for whether or not I want to check my credit report. And usually I'm only going to do it if I see something super fishy. But if that helps take one thing off your to-do list, go for it. I'll drop a link to the CreditWise app in the show notes. All right, guys, that's it for today. See you next time.
Thanks for listening to The F Word with Priya Malani. If you like what you heard, hit subscribe wherever you're listening and leave us a review while you're at it. We're approval junkies. Don't forget, you can find a ton of great resources, content, courses, and other freebies at stashwealth.com. Now, for the capital S stuff our lawyers want us to say. StashWealth is a registered investment advisor. Content presented is for informational and educational purposes only and is not intended to make an offer or solicitation for any specific securities, product, service, or strategy. Consult with a qualified investment advisor, that's us, before implementing any strategy. Investing involves risk, including the loss of principal. Past performance does not guarantee future results. There, we said it.
Did I have that up?